Good afternoon. You're watching Closing Trades on ET now. I'm Anisha Jain. With me is Nikunj Dalmias as well as Aisha Faridi. But for now, the market seems to have reversed the course a bit. Yes, we are managing to hold on to that 18,270 level, but considerably off the highest point of the trading session. At one point of time, we did slip into the red as well. Managed to at least bounce back from those lows. Having said that, most of the sectors have actually turned into the red. It's the PSU banking space which is dragging the most, though IT and auto is something which is trying to hold the green end of the market, but the advance decline ratio has completely flattened out, and the broader market is trading 1-to-1 when it comes to the advances versus declines. Having said that, you have the S&P futures which are also flat ahead of the inflation data which is expected to come out, so that will be perhaps the talking point for tomorrow. But for now, the IT buzzers, the likes of Birla Soft, First Source as well as Tata Elxsi deserve mention. All of these counters are up anywhere between 3 to 10%. The city gas distribution space is also abuzz after a good set of numbers being reported by MGL. So IGL and Gujarat Gas are the other couple of counters. But then it looks like the railway stocks are losing steam. So IRCON, RITES, RVNL, these are the stocks which are under pressure. And to add to that, you also have Zomato, which is on the back foot today. The entire ONDC plays perhaps threatening that stock at this point of time. India Bulls Real Estate has seen a sharp correction from the highest point, and Apar Industries is a bit of a result reaction, Aisha. So a lot of big movers in the trading session today.
Oh, yeah, in fact, a lot of earnings reactions as well, like you just highlighted. MGL, of course, the numbers have been ahead of the estimates. Lower gas costs has managed to aid financials. Kansai Nerolac, we were chatting with the management as well earlier in the day today, and they were talking about excuse me, as to how they're seeing a very strong performance in the decorative as well as the industrial segments. We will, of course, play that management bite as well for you. Similar is the story for Birla Soft as well. Good momentum when it comes to deal wins. They continue to remain strong. And then Mankind, of course, has been the solid most listing. It listed at a 20% premium to its issue price, and from there, it hasn't seen any returning back. Continues to hold higher. At one point in time, it was holding out very smartly. That, of course, is Birla Soft, which is holding at a gain of about 8%. But Mankind, that also will come up for you on your screens. A 20% move on its listing itself. And from there, it consecutively has been seeing a very, very steady ship. That said, the Zomato as well, which is in focus, Anisha highlighted as to how this stock is under pressure. The Swiggy value cut coming in from Invesco for a consecutive time this year itself, and ONDC threat, of course, continues to weigh heavy on the stock. Zomato currently lower by about 4.5% as we speak right now. But for the overall index, we continue to be in good stead, Nikunj. We're holding at that 18,300 mark for the Nifty.
Actually, frankly, for me, you have to understand that the pocket where you saw maximum excitement has that pocket reversed. And guess which is that pocket?
Railways.
That has reversed. That just tells you that in the short term, while I'm not surprised at all, I'm not surprised at all that why railway stocks have reversed. It is not this fairy tale that trees can grow to sky overnight. This is not Jack and the Beans, okay? There is a reason why railway stocks have gone higher, and the reason why they've corrected. Yes, railway is a multi-year theme, I buy that, but I refuse to buy the fact that these stocks or the earnings are going to quadruple just because order books have gone higher, because these are long cycle capex programs. So every railway stock or any company which has got anything to do with railways, prefix or suffix, directly or indirectly, that rate has reversed. The names will just come up on your screen, but for me the one which really matters is RVNL. 75% higher in last 1 month, 20% lower in last 10 days. It is still 70% higher in last 1 month. So railway stocks are still holding on in terms of the meteoric, parabolic or the linear rise they've seen. But I think the cookie has started crumbling. Kunal, रेलगाड़ी उतर गई है पटरी से.
हाँ, थोड़ा I think pit stop हुआ है, but I'm not sure उतर गई है. But as we were
मालगाड़ी हो गई है.
No, as we were discussing in the morning, Nikunj, that you have to understand there are few stocks which are very high beta in nature, and you can't be bullish on these stocks every time, and especially when these stocks run up 70-80%, 100% in a matter of few days. There is no way in which we, one could probably initiate a buy, even though the momentum seems to be extremely strong into these stocks, because the risk reward, it just goes for a toss completely for these names. So the bias has to be for those stocks which are more steady in nature. We discussed the likes of Titagarh Wagon, for example. That stock is far more steadier. Even on a day like today, for example, the stock is seeing a very marginal cut for itself, and so was the case on the upside. The stocks used to see very gradual uptrends, more consistent in nature. But I think RVNL and such kind of stocks which are more high beta in nature, they are bound to get into that phase of correction, and seems like these corrections seems to have just started for these names.
Just started.
Yeah, seems like.
So it will be a long pit stop.
See, because it's on the way up, initially it was 20% circuit, 10%, then 5%. Now on the way down, it will be 5% circuit first on the downside. So the exit becomes difficult for those stocks for those players who wants to book profit.
Naresh, railway stocks were going at speed of Rajdhani. Now will the speed slow down or the train will reverse? Yeah, Vande Bharat actually. Yeah.
So
No,
I
the difference
expected,
between Shatabdi and Vande Bharat, let me tell you.
it's 1 hour.
No, but those station hata diya and the train from Surat starts 1 hour early.
It's 5 hours 25 minutes for Vande Bharat and 6 hours 25 minutes for Shatabdi.
But that includes 2 more stops if you're doing Surat and Ahmedabad.
net-
So
net is the time difference.
अरे भाई 22 stops भी तो हटा दिए. The speed when I came back in Vande Bharat, I had gone for a shoot over the weekend, and there's a live monitor in which it gives you the speed, was 115 to 125. That was the maximum. Shatabdi speed is 115 to 125, 110 to 120. So while it was a great experience, very nice in terms of service and hospitality, and the whole experience of Vande Bharat, I think, is something which everybody should experience. But is this a promise that you will reach faster? I don't think so. Mathematically, no. 2 stops are less. I'm talking about Ahmedabad to Bombay and Ahmedabad to Bombay. That's the route I know. I don't know about other routes.
No, even I'm talking about Bombay to Ahmedabad. It's 5 hours 25 minutes by Vande Bharat and 6 hours 25 minutes.
Minus
by
2
Shatabdi.
stops is what he's saying.
Okay. Mir, you want to come on railway stocks, Vande Bharat, markets?
Or Shatabdi.
take your pick.
You are the fund managers. You guys have picks.
So, so the point is that the fact is that railway capex has gone up from 80,000 crores a year a few years back, 3-4 years back, to 250,000 crores. So that's a hard fact. And when you have significant increase in allocations, obviously companies are going to benefit from it, both the public sector as well as the private sector. So railways, defense, roads, I think these are trends and these are areas in which the government has demonstrated significant commitment to privatization as well as to spending more capex as much as it can. And there are hard numbers to back these finances. So I don't think the theme changes or the trend changes. And this railway and defense have come after a long time as a first area. And when you have something which is at the beginning of a multi-year growth phase, I think there can be pockets of overvaluation, there can be some corrections, but that I don't think will take away from the overall theme of these segments, which is government capex in these segments like road, railways, and defense.
Road, railways, defense, all three. What do you like? What do you own?
Sorry,
No, what do you like within this government theme? Roads, railways, or defense?
So, see, in railways, the stocks are quite small and not very well covered both by the buy side or sell side. So, our exposure is mainly to the capex theme in the public sector, which is the road builders, the construction companies, as well as some of the infra segments. And we have a significant exposure in the defense space.
Okay, so a significant exposure when it comes to the defense space, but the new kid on the block today was Mankind Pharma as well. I know, Mihir, it will be too early to probably take a recommendation as far as the Mankind Pharma is concerned, but the overall pharma space?
Pharma, we tend to look at it more on a case-by-case basis because every company has various mixes of branded, unbranded, generic, exposure to generics, branded generics, etc. So we really look at it on a case-by-case basis, stock-by-stock basis. But in general, over the last few years, our preference has been more for domestic-oriented companies with established distribution and brands because that's where we can see some pricing pressure. The generic space is still very competitive in the US. Europe is anyway tough to crack, and we are seeing significant price erosion continue. So the broad theme is to stick to the domestic-oriented companies.
Let's also listen into the commentary coming in from the management of Mankind Pharma, wherein they sounded quite optimistic about the growth outlook as well.
I can put color on that. Yes, we will be focusing on the chronic side again. In last couple of years, 3-4 years time, we have added a lot of therapy area, starting from Mumbai office, whether it's a respiratory side, whether it's a cardiology, or diabetology, neuropsychiatry, a lot of things have been added. And now it's a time of consolidation. That's the color I can add as far as the OTC side is concerned. You mentioned in OTC side, it's always size of a product which matters. Whatever products you have, to launch a product from scratch and make it big, sometimes it takes 7 to 10 years. So look at Manforce and Dragon News, now Gasofast or Unwanted 72. So plans are very, very simple. Whatever products we have got, focus is only one, that how can and how fast can we reach to the leadership side.
Okay, that's the word coming in from the management of Mankind Pharma. In the meantime, today's buzzers, of course, all earnings reactions, MGL, Birla Soft, these are stocks which are holding out very, very smartly in trade. Kunal, we were chatting with the managements earlier as well, and we will play those sound bites too. MGL, of course, the numbers have been ahead of what the street was anticipating. Similar is the story with Birla Soft as well. Deal win momentum continues to remain strong. But on the charts, what do you see after the big move on the stocks today?
So again, stocks like MGL, IGL, because I've been tracking these stocks very closely, specifically, these stocks have a very odd tendency that on such kind of days when these stocks break out extremely strong volumes, after that you see at least a 1 month of consolidation for these names. There is hardly any follow-through price action for these stocks, and it's been more like a consistent pattern for these names. Similar happened, I think, in the month of August 2022, when I think MGL rallied up 750 to 800 odd mark, and then for the next 1 or 2 months the stock went into a mild correction / consolidation. So I would probably expect that if this is the kind of a scenario for the historical charts, it doesn't make sense to initiate a buy at current levels and wait out for maybe another couple of weeks of pause for the stock prices to initiate a buy. And I think so would be the case with Birla Soft as well. The stock showing signs of a very strong breakout, opening with a very strong gap. So we'll wait out for at least a partial filling of gap today for initiating a buy, but not at current levels.
Okay, so might as well wait out for a bit to fill the gap before buying into some of these city gas distribution names. But on that note, slipping into a very short break, don't go anywhere.
All right, it's a fall of 224 points from the day's high. Now what has turned completely is India Bull Real Estate. NCLT has said, wait, shareholders are not ready to wait. After that NCLT delay in terms of the merger of NAM Assets and Embassy, One India Bull Real Estate faces a delay. The stock has collapsed. So Vamakshi, is it a delay or there are some other concerns?
Well, absolutely. When we look at the merger of NAM Estates and Embassy One into India Bulls Real Estate, that is facing a delay. Like you rightly pointed out, sanction to the merger has been withheld by the NCLT Chandigarh bench. And in fact, the NCLT Chandigarh bench had earlier also raised concerns based on the objections that were cited by the Income Tax Department to the merger. Now, let's take a step back and understand what is the background behind this whole case. Now, in Jan 2020, India Bulls Real Estate first announced its proposed merger with the entities of the Embassy Group, wherein the combined entity would be named Embassy Developments Limited. Now, this received the CCI's nod back in February 21, and a year later they also received a nod from the shareholders. The merger already stands sanctioned by the NCLT Bengaluru bench, but it was definitely pending for approval before the NCLT Chandigarh, as a minority shareholder had appealed against the merger. But as of now, the stock is definitely under pressure as the sanction has been withheld by the NCLT Chandigarh bench, and as a result the stock is definitely tanking in trade, down almost 19% from the day's highest point as of now.
If it's a technical delay, then stock will bounce back, and I think it's a technical delay. I mean, prima facie, it looks to me that it's not that there is a problem in terms of anything in terms of the regulatory framework. There are concerns about India Bulls and some of their concerns about which have been raised by the IT department. Look, NCLT will wait for a clean sheet from everybody. Then only they'll give a go ahead to the merger. So there would be a little bit of more time and paperwork involved. But in the market, the short-term reaction which matters. The stock has fallen 20% on 3.8 crore shares, that's 38 million shares, and the tick is increasing, which means at low circuit also somebody is really selling down. Mir, I want to go back to financials, because financials is where everybody is now excited. And when everybody gets excited, it's rarely that you get big gains. So could financials be one of the sectors where earnings will be strong, everybody will remain excited, but the gains will now be difficult and they could underperform the market after a great 2022?
I would say that if we expect the markets to do well, if we expect the economy to do well, then financials should continue to do well. If you look at the valuations, frankly, they are still not above pre-COVID levels. This is one of the few sectors which is, in terms of valuation, still not that above pre-COVID levels. So to that extent, there is some steam left. Having said that, the performance over the last 1 year, especially in the private sector space, has been quite good, and then the public sector banks also caught up. So you may not see the kind of outperformance that you saw in the last 8 to 9 months. But if the market has to do well, financials have to do well. What we need to watch is not so much the asset quality in the next 4-5 quarters. Asset quality is expected to do well. But I think it's more going to be a function of how credit growth pans out, because we've seen a revival in credit growth, stable margins, and I do expect margins to continue to remain stable, especially for banks. So what we need to watch is credit growth, whether that is panning out.
Let's take a look at some of the IT names and tell you whether they have rebounded at all or not. And let's just bring up a couple of stocks. Of course, while today you're seeing a strong earnings reaction on Birlasoft, but haven't seen a meaningful comeback for IT names. Even if you were to assess how the quarterly numbers were, it was a shocker from Infosys, no better for many other large caps, but actually mid-tier and small cap and mid cap IT companies are the ones which performed way better in terms of earnings as well. Mihir, is the worst for IT behind us, and can these stocks be bought now?
Aisha, what I've seen is that, what matters is the trend of earnings upgrades or downgrades. And we do expect the US economy to slow down in the coming quarters. And by that logic, I think there is a possibility of some more slowdown in the IT space, because corporate America cannot be isolated from the rest of the American economy. So we have seen 1.5 quarters of a bit of a disappointment in this space, but I don't expect the US economy to do a U-turn. So I would continue to remain, underweight on IT, irrespective of valuations, because I think my observation over the past many years is that earnings upgrade and valuations go in the same direction. So when you see earnings getting cut, even valuations start getting cut. They move in the same direction. So if stocks optically might look cheap by some parameters, we can see some more underperformance. And please note that in IT, unlike banks, which we just discussed a couple of minutes ago, IT is one sector where the valuations are significantly above pre-COVID levels. So there is not much leeway for relative outperformance unless IT sectors delivers positive surprises, which I think the probability is low.
Okay, in the meantime, there are earnings coming in for SRF as well. While it's managed to pretty much meet the expectation on the top line with a revenue figure of 3,778 crores, the margins look healthy at 24.6%. And even if you look at the profit figure of 562 crores, it's much better than what a lot of analysts were expecting. So the stock has been just toying around the flat line, up around 2% now after the result reaction. But Mir, before we let you go, I wanted your sense regarding the auto space as well, particularly on the two-wheeler space. Is it time now to get bullish?
Two-wheelers, again, I think there is valuation support, but I'm not too sure about the shape of the rural economy recovery. So far, all indications are that it's a K-shaped recovery in the consumption space, and two-wheelers are a bit below in the consumption theme. So while valuations do look cheap and some stocks have rebounded based on exports, etc. data, I'm still not very convinced about this.
Okay, Mihir, on that note, we'll let you go. Thank you so much for joining us today. Time now to get the closing trades from our technical experts as well. Kunal, what are you strategizing?
So the trade which I would look to recommend at current levels to clients would be on InfoEdge. Naukri, that's the NSE code. The stock looks attractive, inverted head and shoulder pattern, confirming a breakout about 3,850 mark. So that's a buy, expecting 4,250, 300 as a near-term target.
What about you, Naresh?
So that would be Axis Bank. I look at it as a stock which could actually take leadership in the whole banking space. The last 4-year return is not great for the stock. The retest is done, so expecting this to hit a new all-time high in the medium term.
We have the numbers for Raymond also just trickling in. Let's try and address that because I was just looking at the performance when it comes to the consolidated numbers, and it looks like the revenue from operations has come in at 2,150 crores, and that compares with around 1,958 crores of last year, and on a net profit basis it's 196 crores, and that compares with 265 crore rupees of last year, and that's why you're seeing a bit of a negative reaction on the stock because it looks like on the profitability front it's 196 crores versus 264 crore that they delivered last year. We'll try and get more details as far as Raymond is concerned, but for now we'll slip into a very short break.
Well, no, Raymond's, the numbers are not great. Stock is up. Why? Well, it's simple because Raymond's now is on course to almost become a zero debt company. Large part of the changes which have been announced in Raymond's have happened in this quarter where they've sold their FMCG business, and it's all cash deal where they're getting money from Godrej Group and the promoters would be infusing stake back, would be putting money back. I think there is a NCCD which also approved. So markets are now re-rating this entire stock. For a company which was like a sleepy stock, suddenly it has rediscovered momentum. They've incubated the real estate business without raising capital, and that's what, you know, some of the businesses, if there is a push in the right direction and if there is a strong intent both in terms of moving the business to the right direction, and if the promoter and the top management is committed to create value, magic can happen. A year ago, Raymond, I think, was 600. Your details?
I think the numbers are not looking all that bad. You know, I don't know how they stack up with the market expectation. While yes, the net profit is down 26%, revenues are higher nearly by about 10%, and the EBITDA as well has seen an uptick of about almost 18.5% or so. There's been a bit of a margin expansion to 15.7% versus 14.5% on a year-on-year basis. So the numbers don't look all that bad. And Nisha, I think you were making the point there is an extraordinary component, right?
No, I was just talking about the EBITDA margins being at 17.3% versus 17.6%, and there is other details that has come in with respect to the consolidated net debt being reduced by 400 crores, which now stands at 689 crore, and they're saying that going forward the sustained net debt reduction year-on-year basis is going to continue on account of the cash flow generation. The management also says that in a continued commitment to create shareholder value, they are delighted to state that the new entities will be zero net debt and are poised to scale new heights. With respect to the other internals, the branded textile segment has reported revenue of around 902 crores, pretty much flat year on year. Branded apparel, the top line growth has come in at 19%. You also have the garmenting business, which has seen a growth of 44%. So a lot of these are moving parts for this company, but for now it seems it's a bit of a mixed number coming in. Operationally speaking, it's not much to write home about. Net revenue jumping by 8%, profitability down 26%, slight miss on the margin, but at least it seems that the volume growth has been strong and the management is guiding for a further growth, and that's why we're seeing a bit of a reaction on that stock. Chakri Lokpriya also joins us on the show. Chakri, do you have a view on Raymond's? Because as we are talking about, it's changing its entire color as well.
Good afternoon. Raymond's is not a stock that I've invested anytime in the recent past, so I don't have much of a view, but Nikun's comments are very valid. Companies like this which are transforming themselves in terms of lowering debt, and also Raymond's is going through a marked shift in terms of its business model of being a male-only apparel company to in its apparel business to adjacent businesses that it wants to get into. So I think the trend is in the right direction, but I don't have the details.
So Chakri, what has been your strategy in this uptrend?
The strategy in this uptrend is one, thankfully we got banking right. Second, I think consumer, because interest rates have largely kind of peaked, I think, as far as India is concerned. Maybe they'll be in a pause for some time. So that's good news for, margins at least will start holding up. Input costs are coming down. So when I say consumer, it is all these small ticket items. Hotels, have done well, will continue to do well. B, all the QSR, the Jubilant, the Devyani type of companies. And three, actually, if you can kind of club even auto ancillaries, companies that supply to the auto companies, of course, that's a derived demand. But I think these sectors will do well.
The small cap index has turned in the red now. Nuresh, are you there? Indian Hotel is at a new high.
So the trend continues in stock-specific moves. So we are seeing a chalet hotels coming closer to a new high. So I think this should continue stock-specific basis on the mid-cap, small-cap. One day of a pause is needed. We've had a rally for the small-cap index over the last 2-3 weeks now. So the trend remains positive. A little bit of a pause is part of the game. So looking at new ideas across the board.
Holding on to Indian Hotels, you plan to hold on to it? If yes, for how long?
So now is the time where you keep trailing stop losses. So the day it starts falling 5% from the top is the time when you want to get out.
Chakri, Zomato is down 6% in trade. Your view?
This is a sector which consumer-facing sector, but again, without any kind of pricing pressure. You've seen similar examples even in a Paytm. You can call it a consumer business. Their margins outlook is weaker than what they thought it would be. I think the same trend will kind of continue. The excesses of, the 2 years ago kind of valuations, unfortunately, we will not get any time in the near future. So I think still it's space to go.
That's the stock which is in focus. It's really been all over the place. A little bit of a nosedive as soon as the numbers came, and now again a recovery coming in place. So let's take it across to Vamakshi, get in a sense of what really happened. And Vamakshi, why is the pad down, whereas the other operational numbers seem to be, quite okay?
Well, absolutely. Let's look at the company's performance now. In the press release, the company does say that they have recorded 6 consecutive quarters of strong revenue as well as profitable performance. Revenue did see an uptick of almost 10% on a year-on-year basis. It has grown from 1,958 crores to 2,150 crores. The Q4 revenues grew by nearly, and apart from that, when we look at the EBITDA, that is also seeing an uptick of almost 18.4% on a year-on-year basis. In fact, this is the highest ever quarterly EBITDA for Raymond. Now, net profit has seen, however, a dip of almost 26.2% on a year-on-year basis and has come in at almost 194 crores. EBITDA margin, however, has seen a good uptick of almost 114 basis points, up from 14.5% as we saw in the same quarter last year to almost 15.7%. On the other hand, the company has also managed to reduce its net debt by almost 399 crores during the quarter. When we look at the management commentary, the CFO is saying that the FY23 has been a year of exponential growth. They have managed to double their net profits. In fact, the recent corporate action announcements are expected to fuel the company's future. There is clear focus on the B2C lifestyle business and real estate business, and in fact, in their continued commitment to create shareholder value, they believe that these two new entities, that is Raymond Consumer Care Limited as well as Raymond Limited, will be net debt zero and are poised to scale to new heights. Apart from that, when we look at their segmental performance, sales growth segment-wise, branded textiles grew by almost 1.8%, while branded apparel reported a top-line growth of almost 19%. The garmenting segment also reported a growth of almost 44%. So largely, those were all the important numbers that have come in from Raymond so far.
Okay. The small cap index is down. Zomato is down. Is it ONDC impact? Is it general profit booking? Is it Swiggy valuation or all? I don't think it's Swiggy. I think it is A, profit booking. B, there is this fear that ONDC impact could have impact on the long-term fundamentals of the food delivery business. I think that is something which is having impact on the perception per se. Chakri, I go back to Zomato, and Anisha has asked you this, but do you think it would be naive to compare Zomato and Swiggy? Because Swiggy valuations have been hunkered down last evening, and Zomato valuations were hunkered down, or they've come down because of price discovery 3 months ago. So today markets are saying, okay, Swiggy valuations are down, so Zomato will also go down. Do you think it's too naive to put 2 and 2 together here?
No, I don't think so, because you raised a couple of important points. One is, if the government does step into this business, then clearly the margin profiles of the whole industry, or rather the expectations of that margins will improve sometime in the future, will clearly not hold up. Second is in terms of the Swiggy and Zomato. Swiggy has actually been taking the private equity investors are kind of using Zomato as a benchmark, and as its valuation is coming down, so Swiggy has been rated down. So then this chicken and egg story is kind of impacting Zomato more, and therefore, all their growth plans, I think, which again need capital, those are kind of, I think, will go on the back burner, which means it's going to pull back growth of the company. For a growth company, holding back growth is clearly the biggest bad news in its valuation.
There's numbers also coming in from Westlife Development. The stock was already going weak into the numbers. I think it's sitting with a cut of around 4.5%. And the first look, as far as the number is concerned, the sales have come in at 543 crores, and that compares with 444 crore of last year. And profitability wise speaking as well, the reported profit after tax has come in at 203 crores, and that compares with 156 crore last year. So looks like it's an okay performance for now. Let's see what the expectation was and how the stock reacts. But Westlife Development, as well as some of the other QSR names, and even Zomato for that matter, Kunal, what's the trend on the chart?
Well, Zomato, I think, is going through a bit of a profit booking because I think I remember clearly almost a couple of weeks back when the stock was at 50 to 54 levels, we were indicating that 64, 65 is a zone of resistance. This also coincides with the fact that the stock had come back towards I think the January or the December highs. That was a zone of 64 to 67 for Zomato. It spent almost 2-3 months at that point of time, so from September to December, and then the stock went into a corrective phase. So it's come back towards a resistance point, and that's why I would believe it's for profit booking. This could probably also indicate that the stock may be now getting into a time-wise consolidation. So, hoping that the next couple of weeks the stock would get into this time-wise consolidation at the 60-odd mark, plus or minus 3-4 rupees for Zomato. On the other hand, from the other stocks, I think QSR spaces, Jubilant Food is something which looks attractive. 450, 455 is where the stock is trading. It's given a decent recovery from the previous lows of 420, 425. At one point, the stock was on verge of breaking past about the 500 levels. So I think it's been a decent comeback for Jubilant Food in the last 1 month. Now I think at 455 levels, it's also one of the other attractive trades from the space.
Could I two stocks, considering you've been in Tata Motors, bull for a very, very long time, now at a 52-week high for both IHCL as well as Tata Motors, are you booking profits at all?
Not at all.
Not at all? So
I mean, classic phase. You don't go through, you don't sell your winners just at the time when you're expecting that the up markets would sustain for a much more longer time. So I think there is no reason why to sell Tata Motors just because it's run up to those levels of 500 and maybe for Indian hotels. Where the stock has clocked a fresh multi-week, multi-month high.
what's your 1 month, 1 year price target in Tata Motors? 4 digits?
It's not a 1 year time frame which I'm looking out for. At least it's the next 3 to 5 years bet for me.
Peter Lynch had once famously said something very nice. He said that you should never cut the flowers and water the weeds. And it is so much applicable when it comes to staying with winners. Rakesh Jhunjhunwala became Rakesh Jhunjhunwala not because his every stock became a multi-bagger, but the ones which he stayed on with to the course of 5 years, 10 years, 2008 crash, 9/11 problem, 2008 COVID, is he had this ability to bear the pain, bear the pain, don't get into, never had the temptation of booking gains, and he in a sense stood in his investments for years, and that's what I think it is.
Similar with Buffett as well.
That's why you got Buffett, Rakesh Jhunjhunwala. I mean, what identifies them differently is that ability to not time the market, but spend time in the market, and that's an extraordinary. You need an extraordinary wiring to do such a thing.
Yeah, like they say, investment is actually the most boring thing to do. Yeah. You don't have to do anything; you buy and forget.
Aisha, if you're making a car or if you're constructing a building, the law of physics they will apply. But when you're dealing with markets, you have to deal with human behavior. And human behavior sometimes can be so complex that exactly a month ago we were talking about breakdown, and today we're talking about breakout. The same FIs who sold India, I think the same folks were coming back. So that's markets for you. Chakri Bada, we haven't discussed Adani group of stocks. I mean, immediately after budget, every second question or at least 8 out of 10 questions were centered around Adani. Have markets forgotten that pain? Have markets moved on from Adani stocks?
Yeah, I think in terms of all the Supreme Court setups, in terms of the various work that is going on, that is kind of a good news to keep the stock away from bad news. Valuation-wise, there are all these sum of parts, high growth stories. Clearly, they've cut down about 3.5 billion of capex programs for For instance, in one of, I think in Adani Ports, they've cut down 3.5 billion of capex plan. So they are also rejigging themselves to a lower growth trajectory until they stabilize a bit more. So I think these stocks will have to come up, catch into the valuations, but so haven't done anything new in the space within the group.
Nuresh, in this uptrend, Adani group of stocks have not participated. Does that mean that now the sideways consolidation in Adani group of stocks is going to be a long process? Because just think about it. I mean, in last 1 month, I'm using last 1 month because last 1 month has been almost like a V-shaped recovery for the market or a linear recovery for the market. Adani Enterprises is up. No, it's up actually. It's up 8%. Adani Ports is up 8%. I stand corrected. I thought the gains were not that great. And then you got Adani Power, which is up 24%. So I got mixed up, folks. So I apologize. Okay, Nuresh. Now that we've looked at the data for Adani group of stocks, where are they headed?
So I think the names like Adani Total, Adani Wilmar, these names which saw the largest price correction would get into a sideways period. Adani Enterprises also. The relatively better names, which is when I say better names in terms of institutional participation, like Adani Ports, Ambuja Cements could actually go up over a period of time. So if I have to take a bet out here, I would go with Ambuja Cements, which looks the most promising one. Because if you look at what has happened with the rest of the cement space, we are seeing Ultratech coming near to a 52-week high. And you have Ambuja Cements just still lagging behind by a big margin. So the trade here is to go with Ambuja Cements in the whole pack and avoid the rest of the pack.
Okay, since we're talking a bit about the capex theme, tomorrow we have the numbers coming in from L&T. Let's go across to my colleague Asesha to find out what the expectations are, because today as well, CLSA wrote a note talking about that they are expecting a constructive FY24 guidance. They are talking about the execution and its margin to grow by around 10 to 12%. They're also expecting a margin expansion by 25 to 50 basis points. Let's see whether the company delivers or not. But let's go across to my colleague Asesha to find out what the street is expecting.
We are expecting decent set of numbers from L&T this time around. Revenue growth is expected to be led by both core as well as non-core businesses. Consolidated revenues for the fourth quarter could come in at about 59,250 crores, which will be an uptick of about 12% on a year-on-year basis. As far as margins are concerned, they are expected to be largely stable. Expecting margins for fourth quarter to come in at 12.4% versus 12.3% that the company reported same time last year, and we are expecting flat margins on a year-on-year basis because of unfavorable input prices that the company experienced in the quarter gone by. Let's also talk about order inflow position then. Order inflows are expected to come in at about 70,000 crores, and this will be led by hydrocarbon, building and factories, power and TD, and metal segments this time. Let's also talk about key monitorables then. Margin trajectory and raw material pricing, commentary from the management, momentum in their green energy orders will be the key monitorables as far as L&T is concerned. But all in all, we are expecting decent set. Revenues could grow at about 12%. Margins are expected to be flat.
Thanks, Asesha, for that. But time now to get some of the BTSC ideas from our chartists as well. Nuresh, what's on your buy today, sell tomorrow radar?
So first is the buy on Coal India, which is nearing a new 52-week high on a dividend-adjusted basis. It looks promising. Stop loss at 233 and a target price of 250. Second is the buy on Axis Bank, shaping up for a short-term breakout. A stop loss at 880 and a target price of 920.
What about you, Kunal? What's the BTSC idea?
So the first is a buy on Axis Bank. The stock is performing quite well today, outperforming most of the other private sector banking names, even in the last 15-20 minutes of the exaggerated correction. So that's an indication that the momentum is quite strong and should sustain for at least next couple of days. Buy with a target of 925, stop loss 865, and Divis Labs has been one of the class performers from the pharma stocks, breaking past about the 200 DMA today as a sign of confirmation that a major reversal seems to have happened for Divis Labs. Buy with a target of 3550, stop loss at 3270.
Okay, a bunch of stock ideas coming in there. Just looking at some of the other names as well, which are actually holding up in trade. Birlasoft, of course, like we mentioned, that's going good. MG continues to see steady gains, and there's Tata Com as well, which is sprung up about 5.25%. Didn't start the session as strong, but right now the stock is at the session highs, 6% in the cash markets, and still going strong as we speak. A solid move coming in on Tata Com. 1300 is where that stock is. Manappuram, SRF, these are the other names which are also looking very, very smart as well as we speak right now. Let's address the losers as well. While Indiabulls Housing hasn't seen a material recovery at all, the Nifty as well has completely given up all of its morning gains, although they weren't quite big any which way. But there's Abbott India, there's PNB, there's UPL, and then Oracle Finance, which is also languishing in trade as we speak right now at 6.5% of a day. Kunal, I know it's a little foolish to even talk about it, but what's looking like the weakest link in the market, or a sector that will not participate in the rally that we're currently seeing, or the run up to the life high?
A tough one, frankly, Aisha. I can't, on the back of the hand, actually figure out which sectors would probably underperform. But my sense is that the initial phase could be more of profit booking, and that could be more on the large cap names. For example, the auto stocks, Bajaj Auto, I think Eicher Motors, they did exceptionally well in this leg of uptrend. So possibly these stocks can get into a correction first. From the banking names, I think HDFC Bank corrected already last week. So you may probably see Kotak Bank, etc., which have been the other fresh performers in the last 1 month of price uptrend. They could get into a correction. But just at the first indication, very difficult to categorize it, which are the sectors which can underperform.
Even IT?
I'm not sure. So it's in a consolidation phase. So I don't sense that the underperformance would continue or would come back again for the IT. They've already been underperforming. So I don't see any change of trend there.
Fair point. 8 minutes to go. Price volume broke out in carborundum. What is carborundum? It's part of the Murugappa group, and they are essentially a play on capex, soft capex. They make abrasives, they make machine parts. There are two types of capex. One is soft capex, when you are doing largely brownfield, not greenfield. You are expanding machine capacity, you are adding an assembly line, you are adding another relay line. That's the time some of the smaller soft capex companies, they tend to benefit. And that's where, let's say, Tube Investment and Elecon Engineering, SKF Bearing, this entire cohort of engineering specialty companies, they do well. When there is greenfield capex, which is, let's say, Grasim is setting up a cement capacity, they are moving into paints, they would buy land, they would buy building, they would be constructing, they would be moving equipment. That's the time large industrial capex does well. Power plants will be set up, gensets would be set up. So something like carborundum is a play on soft capex. Meanwhile, Westlife Food numbers have also come out. They are the franchisee for West and South. They sell McDonald's burgers, and total revenue is at 550 crores, EBITDA at 100 crores, up 26%. Which means Indians are buying more burgers. We are eating more junk food, or perhaps drinking more coffee.
You said Vapi had what? Starbucks and?
Starbucks,
McDonald's.
Burger King, McDonald's, and not just one. It's like a 3-hour drive from Bombay. It is not like I've just gone to the center of the world and come back. But in the 3-hour drive, I saw 2 McDonald's, drive-in outlets, 2 Burger Kings, and a Starbucks. So it's just the way how things are
So
evolving.
there you go. I mean, Indians don't just aspire to wear good clothes and buy new cars, but also aspire to eat well.
Yeah. So right now, what we think is unhealthy junk. India is a price-sensitive market that's cheap and also abundant, and also healthy if you're driving on a highway. Yeah. So things are expanding, and this is just the west and the south. So all India, if you add up the numbers, I think the numbers would be very, very different. Chakri, you want to comment on that?
This as a segment will do well. If you look at a counterpart like Devyani, so these guys also make a similar kind of, Pizza Hut, all those companies. So they are seeing increase, and KFC. KFC is seeing a very big traction across the country. One of the fastest growing fast food within the country, and they're adding new distribution outlets, changing the formats to dine in plus takeout, all that kind of stuff. So which means volumes are coming back very, very strong for the QSR segment. And if KFC will do well, then Westlife also should do well.
Okay, so that's the take coming in. Let's go across to my colleague Shrishti as well. She's standing by to tell us what the expectations are from Dr. Reddy's. The company will report its numbers tomorrow.
Well, if we see the expectation this time around, so on a sequential basis, we are expecting a decline onto all the headline numbers. That's on the back of a muted set of a performance coming in for their India business, as well as a degrowth for their US business. sequential basis. But other than, if you look at the numbers on a YY basis, then we are expecting a healthy jump. So let's quickly look out the India sales expectation this time around. The sales is expected to be up 13% on a YY basis, but down 7% on a quarter-on-quarter basis, and 1,050 crores is what we are expecting for the India division. The other main division is their US business, wherein the G Revlimid, that particular drug, sales is expected to be flat on a quarter-on-quarter basis, not much support coming over there, and overall, if we see, then a 24% of decline or a degrowth on their revenue for the US markets is expected, with $285 million is the expectation. Now let's come to the headline numbers. Onto the revenue front, we are expecting 6,043 crores. That will be a degrowth of 11%. EBITDA is expected at 1,510 crores, and the margins are also expected to decline from 30.4% last quarter to 25% this time around. And lastly, onto the profit figure, we are expecting a 941 onto the bottom line of the company, and that will be a decline of 29% on a quarter-on-quarter basis. It does have an impact of the seasonality as well as the pricing pressure in the US markets, but lots more to look out for the management commentary, where the commentary on the margins, the commentary of the sales, specifically the G Revlimid sales, as well as the product new launches for the next 12 to 15 months in the US markets will be the key to watch out for. So that's the expectation from Dr. Reddy's. Back to you.
Kunal, Dr. Reddy's is almost at the 52-week high, right?
Yeah, I think 4,009, yeah, almost at a 52-week high, 49.75.
And Divis is looking strong.
Yeah.
Sun Pharma has bottomed out.
Sun Pharma is actually the weaker one,
okay,
as of now.
So DRL and
Divis are the stronger ones. Glenmark, Zydus from the mid-cap end looks very strong.
So Aurobindo Pharma we missed out. A 380 stock has become about 600, yeah, 500 plus.
600, so 400 became 600 plus.
That's just, we've not, I mean, everybody missed Aurobindo Pharma, let me put it this way. Because this was one stock which in a sense had Rakesh Junwala as an investor. And he said, look, it will turn around, it will turn around, it will turn around. And then he had to turn around his view and he sold out. So, you know, that's just been such a big pain point in terms of Aurobindo Pharma. The debt and the corporate governance just did not kick in. But you know, markets are market 600. I didn't realize it actually. 380, 400 has become 600.
Yeah, 400 the last.
In fact, most of the pharma stocks, at least the big names, would be up 30 to 50% from the lows.
Yes. Even the likes of Biocon from 200 to 245 right now.
It's a big comeback, man. We don't realize it actually. Viresh, we can get one comment on pharma before the market they shut. Viresh? Okay, he's not there. A minute to go. Chakri, let's get your closing comments. At 18,300, do you think we are done for the gains of the year,
I think the market has has a good chance to go higher. If you look at the last 2 years' return, the market has largely been flat, index returns. So this is not clearly an overheated market. Valuations are only 20 times for depressed earnings. So from here, as RBI peaks out and rates start going down, I think economy revives, therefore market goes higher from here.
Right, okay, let's quickly wrap up how trade has panned out. Absolutely flat on the index, but 18,317, guess you can't complain with that one. For the futures, 18,259 for the Nifty Spot. The sectoral winners today have been oil and gas, textile, telecom, technology to some degree. The losers, realty, cement, cap goods, and banks and financials. So Divis, Coal India, Nifty Bank, M&M, Adani Enterprises have all been winners within the Nifty. UPL, ITC, SBI, Bajaj Finance, and Hindalco have been the laggards, along with the JSW as well as Grasim and Power Grid. The broader market did a lot better, although the bias there was also towards the red. UPL, PNB, Abbott India, Indiabulls Housing, Oracle Finance, these have all been losers today. And on the flip side, MGL, Tata Com, Manappuram, SRF, Birlasoft have all stood out to be winners. But that's it then on this edition of Closing Trades. We're going to wind it up right here. We'll see you again tomorrow morning at 8 a.m. with all the market action.